Hi, I'm Debra Rudd. Welcome to the Hodgin Law PC International Tax Lunch. We do this almost every month on the last Friday of the month, 9 a.m. Pacific Time. You can listen online or watch the show later on YouTube. This month's topic is Life After Expatriation, Common Tax Issues. Let's get started. First, I'm going to give an overview of what expatriation is and basically who this matters to. Then I'll talk about estate and transfer tax issues, then U.S. retirement income, double tax problems, ongoing U.S. reporting, and then a quick summary at the end. First, an overview of expatriation. When I'm talking about expatriation here, what I'm talking about is the tax meaning of expatriation. This means the relinquishment of your U.S. citizenship, or if you have a green card and you've had the green card during 8 or more of the last 15 years, and you abandon that green card, then you're an expatriate. And here's a graph to help illustrate how this works. First, you have to be the right type of person and then have the right event for Section 877 Cap A, the expatriation rules, to apply to you. And then you have to check, is this going to be painful or not? In other words, are you going to be a covered expatriate or not? And then the tax consequences of expatriation depend on whether you're covered or not. So at the bottom, you see we have citizens or long-term residents who have the expatriation event, and long-term residents are lawful permanent residents who meet the time criteria of having that status during 8 of the last 15 years. If a citizen or long-term resident terminates their citizenship or lawful permanent resident status, that termination is the expatriation event. That person becomes an expatriate when they do that. An expatriate is either covered or not covered, and there's 3 financial tests that you look at to see if someone is covered. Here are the 3 financial tests. All of these must be met to avoid covered expatriate status. If you fail one of them, then you're covered. To avoid being covered, your net worth has to be below $2 million. Your average tax liability for the 5 years before the expatriation year has to be $206,000 or less, and that's the 2025 amount. It's indexed for inflation every year. And all your tax obligations under Title 26 have to be met for the 5 years before the expatriation year. Title 26 is just the Internal Revenue Code. So that's just saying all your tax obligations have to be met. There's a couple exceptions to covered expatriate status. For these, as long as you meet only the certification test, it doesn't matter if you meet the net worth test or the tax liability test. These exceptions are if you're a dual citizen at birth and you continue to be a citizen of and taxed as a resident of the other country, then all you have to meet is the certification test and you can be non-covered. Or if you're under age 18 and a half at the time of expatriation, as long as you meet the certification test, it doesn't matter if you meet the tax liability test or the net worth test, you can be a non-covered expatriate. Now on that second one, typically someone would have to wait until age 18 to be an adult capable making the decision of giving up their citizenship. So you have a 6-month window between reaching age 18 and age 18 and a half to qualify for that exception. Now here's a helpful decision tree or flowchart that kind of shows how you can approach this. The first thing you want to check when you're going to be an expatriate is the certification test, because it doesn't matter if you meet any exceptions. If you fail the certification test, you're a covered expatriate. So if you're trying to avoid being covered, you want to make sure that you've met the certification test. You probably want to try to meet the certification test even if you're not covered, because as you'll see on the next slide, you have to report to the IRS whether you meet the certification test or not, and if you say you don't, you might be inviting an audit for prior year tax returns. So let's say you do meet the certification test, or that you amended your tax returns before you expatriate so that you'll meet the certification test. Next, you can check if an exception applies. And up at the top, the green box, dual citizen at birth or 18 and a half or younger, if either of those apply to you and you've already met the certification test, you can skip right to the end. You know you're going to be a non-covered expatriate, you're not going to pay exit tax, go ahead and expatriate. But if neither exception applies, then you need to look at both the net worth test and the tax liability test. And first, if you pass the net worth test, great, move on and look at the tax liability test. If you fail it, you're a covered expatriate regardless of the outcome for the tax liability test. Let's say you pass the net worth test, move on to the tax liability test, and if you pass that one, you're not going to be a covered expatriate, go ahead and expatriate. If you fail that one, then you're a covered expatriate. And here's what this looks like on the forms, on the tax form. This is Form 8854, Part 2, Section A. Question 1 is where you show your numbers for the tax liability test. This is when you enter your tax liability for the 5 years before expatriation. The IRS can easily add up these numbers, divide them by 5, and see your average tax liability. Line 2 is where you enter your net worth on the date of expatriation. So this is the net worth test. Line 3 is a new question for 2024. This did not appear on previous versions of the form. I think this is related to the net worth test because it asks, have there been significant changes in your assets and liabilities for the 5 years ending before the date of your expatriation? And then it tells you to see the instructions, and the instructions say that significant changes have occurred when your net worth is over $2 million before expatriation, and then it's below $2 million on the date of your expatriation. So they're looking to get information about situations where maybe you gave away assets before expatriation to reduce your net worth. Questions 4, 5, and 6 cover the 2 exceptions, the dual citizen at birth and the under 18 and a half exceptions. Most people answer no to those, but occasionally I get to work with someone who only has to pass the certification test and doesn't have to worry about the tax liability test or the net worth test. And then lastly, question 7 is the certification test, and you have to answer that under penalty of perjury. The way it's written and the way you have to check the yes or no box, I always think it's a good idea to be able to say that you meet the certification test and check the yes box. So this is why, even if you're going to be covered under the net worth test or the tax liability test, I think it's a good idea to always try to meet the certification test. In terms of the tax consequences of expatriation, they're pretty different depending on whether you're a covered expatriate or a non-covered expatriate. Covered expatriate sounds like a good thing, but it's actually a bad thing. This is where all the bad tax results are. Both covered and non-covered expatriates are going to switch from resident to non-resident for U.S. income tax purposes. But only covered expatriates have the exit tax and the Section 2801 tax to deal with. They have a deemed sale of all their worldwide assets, not just U.S. assets. They have to pretend they sold everything they own in the world and pay tax on any gains. There is a gain exclusion, but it's still a pretend sale of all your worldwide assets. IRAs, certain pensions, trust interests, etc. are treated as distributed. Now it's important to note that 401ks do not typically get this treatment because you can file Form W8CE to elect eligible deferred compensation treatment, which just has a 30% withholding as you take distributions rather than a deemed lump sum distribution. But IRAs in particular and foreign pensions, those are subject to a pretend lump sum distribution on the day before expatriation. There's also a 40% tax on assets given or bequeathed to U.S. recipients, and we will talk about that in this presentation. That's a pretty major post-expatriation tax impact. So because of all these negative tax outcomes of being a covered expatriate, it's pretty common for people to do some planning prior to expatriation. The first and most common thing people try to do is to avoid covered expatriate status. If you can successfully do this, then you don't have to pay any exit tax, and there's no tax to your U.S. heirs when you die or when you give assets to them. Another common planning goal is to optimize for the lowest exit tax possible. So if you're in a situation where there's no reasonable actions you can take to avoid covered expatriate status, and you've accepted that you're going to be covered, you might have ways that you can reduce your exit tax. Maybe you give away your most highly appreciated assets to your spouse or your children, kind of as a form of early estate planning. Another planning goal is to avoid tax on your estate, inheritances, gifts. As we'll talk about a little bit later, this is a major issue. You may also want to avoid double tax situations because the exit tax, it's a U.S. tax and it's on a pretend event, so there might not be a matching tax event in another country, so you don't get a foreign tax credit, but then later on there's a tax event and you still don't get the foreign tax credit, so ultimately over time you end up paying double tax. We'll talk about that later too. And then probably the most common planning goal that I see with the clients I work with is they just want to simplify their situation. When you have assets both in the US and in foreign countries and you have to file multiple tax returns, sometimes with different due dates using different tax years, it can be a lot of work and take a lot of your time to comply with all the rules that you need to follow. So simplifying your situation and making it so your financial life and your tax life is very easy is a common goal. And on this next slide, I have this pipeline illustration just to kind of show how you want to think about expatriation. First, you have the idea that maybe this is something you want to do. Then you're going to research and plan and learn about it and learn what you should be concerned about and figure out what you should do to avoid negative consequences. You form a plan. Then you execute that plan, you make changes, you take actions, you do whatever you need to do to organize your financial life to minimize tax consequences, to make things easier for practical purposes. Maybe when you're switching to non-resident status, your US bank doesn't want to keep your account open anymore. So there's a lot of things that you're going to have to do when you're planning to expatriate. You need to fix your tax compliance issues to pass the certification test. So if you have anything that hasn't been reported, any missing information returns, any unreported income, you want to fix that before expatriation. Then you renounce your citizenship, relinquish your green card. That is the act of expatriation. Once you do that, you're an expatriate, and that triggers exit tax. You report the exit tax on your expatriation year tax return, and you pay the tax then, or ideally in installments in the prior year. And then you might have to deal with post-expatriation tax issues, the subject of today's presentation. And I have these arrows going from exit tax and post-expatriation tax issues back to the research plan stage, because what I wanted to illustrate here is that these events that take place as a result of renouncing or relinquishing your citizenship or your green card, the exit tax, the post-expatriation tax issues, you need to think these through before you expatriate. Once you've expatriated, it might be too late to fix them. So the planning stage needs to be for exit tax, but also for what's your life going to look like after expatriation. How is your income going to be taxed? Where will it be reported? What happens with all your assets when you die? What happens if you want to make a gift to your nephew? These are important things to understand before you change your citizenship or relinquish your green card. So let's start talking about the first topic for today, estate and transfer tax. There are 3 topics here that I want to cover. First is U.S. estate tax for non-residents not citizens, U.S. gift tax for non-residents not citizens, and then lastly, the Section 2801 tax on covered gifts and bequests. The first 2 apply whether you're a covered expatriate or a not covered expatriate. If you have a U.S. estate, when you die, there will be U.S. estate tax. If you give a gift of U.S. situs property, you might have to deal with gift tax. But Section 2801 applies only to the recipients of assets from covered expatriates. First, let's look at U.S. estate tax for non-residents not citizens. After you've expatriated, typically you will be a non-resident not citizen. That means you're neither domiciled in nor a citizen of the U.S. The concept of domicile, and therefore the concept of non-resident status for estate tax purposes, is different from the idea of residency for U.S. income tax purposes. A person acquires domicile in a place by living there for even a brief period of time with no definite present intention of later moving. What this means is domicile is a facts and circumstances test, and it depends on where you live and what are your intentions. So it's very different from the idea of residency under the income tax rules. If you are a non-resident, not citizen for estate tax purposes, Then what is subject to U.S. estate tax is U.S. situs assets. If you're a U.S. citizen, then U.S. estate tax covers your worldwide estate. So this is a pretty major change. Anything you have left in the U.S. after expatriation, you can assume is going to be subject to estate tax. This includes U.S. real estate, tangible personal property located in the U.S., the stock of corporations that are organized in the U.S., U.S. retirement accounts, certain debt obligations of a U.S. person, and this is not a complete list, just the most common stuff. For non-resident, not citizens, there are some exemptions that apply and some modifications from the normal estate tax rules. As we saw on the previous slide, the first one is that the estate tax applies only to assets that are situated in the U.S. for purposes of U.S. estate tax, or as it's defined under the estate tax rules. The next is people who are domiciled in the U.S., like U.S. citizens or green card holders living in the U.S., they get a $13.99 million unified credit. That amount, when you become a non-resident, not citizen, reduces down to $60,000. So it's almost no exemption at all. For practical purposes, you can consider your entire U.S. estate to be subject to U.S. estate tax. The marital deduction is disallowed for non-U.S. citizen spouses unless you put the property into a qualified domestic trust. And there are some statutory exclusions in Section 2105, such as life insurance proceeds, certain bank deposits and debt obligations, art on loan for exhibition, the foreign portion of RIC stock. Some of those are going to be more common than others. Lastly, some property is exempted by a tax treaty if you happen to be in a country with an estate tax treaty with the U.S. when you die. Or happen to be living there, sorry. There are things you can do as a non-resident, not citizen, to solve the U.S. estate tax problem or to make it better. One common planning technique is to put your U.S. assets in a foreign corporation. If you do that, when you die, the stock of the foreign corporation did not die, so those U.S. assets remain in an entity that continues to exist even after you die. So the assets inside the foreign corporation are not subject to U.S. estate tax. Another common planning technique is qualified domestic trusts. You may be able to take advantage of treaty benefits if there's an estate tax treaty that applies. Life insurance, like a simple term life insurance policy, can be used. You make the death benefit equal to your approximate estate tax, and that is an estate tax plan right there. You could have non-recourse debt on your U.S. real estate because liabilities reduce your taxable estate. And you can give gifts of your assets, kind of like a early estate plan. You can give amounts up to the unified credit before expatriation or before you stop being domiciled in the U.S. And you can give U.S. intangibles free of gift tax after expatriation, as long as you don't give them to a U.S. person when you're a covered expatriate, because that's a Section 2801 issue, as we'll see in a moment. The next thing that non non-resident, not citizens might have to deal with after expatriation is U.S. gift tax. This uses the same definition of non-resident, not citizen that is used for estate tax. Gift tax and estate tax both use the concept of domicile. Gift tax applies to U.S. real property and U.S. situated tangible personal property only in the case of non-resident, not citizens. And cash, the way the rules around this are written, it's a little bit ambiguous. So to be safe from U.S. gift tax as a non-resident, not citizen, the best way to do this is to give cash outside the U.S. That means the donor has cash in a foreign bank account, the recipient has a foreign bank account, the cash goes from the donor's foreign bank account to the recipient's foreign bank account, and it never touches the U.S. at all, either leaving or coming in. That avoids any ambiguity, and you're giving non-U.S. situs property. There are some exemptions that apply for non-resident, not citizens. Obviously, you do not get the $13.99 million unified credit anymore, but you do still get the annual gift exclusion per donee of $19,000. You can also give up to $190,000 per year to a non-citizen spouse tax-free. If your spouse is a U.S. citizen, you can get an unlimited marital deduction for gifts to your U.S. citizen spouse. So the important thing here is the status of the recipient spouse. If they're a U.S. citizen, it's tax-free. If they're not a U.S. citizen, you have a $190,000 limit. You can also give tuition and medical expenses for someone else if you pay the tuition or medical expenses directly to the entity that's providing the education or the medical care, then that is exempted from your gift tax. And lastly, certain gifts to political organizations are exempted. For reporting your gifts, currently Form 709NA is in draft form. It's pending approval, and taxpayers are instructed to continue using Form 709 until Form 709NA is published for use. So I just wanted to draw everyone's attention to this fact that non-resident, not citizens, at some point in the future will have to start using this other form, not the traditional 709. Next, I want to talk about the Section 2801 tax on covered gifts and bequests. And as I mentioned, the U.S. estate tax and gift tax apply whether you were covered or not. If you're leaving an inheritance or giving a gift of a U.S. situs asset, then you're going to deal with either the U.S. estate tax or the gift tax. The Section 2801 tax is interesting in that it applies to worldwide assets, not stuff that's just situated in the U.S., and it applies to anything received from a covered expatriate by a U.S. person. And it's important to look at the specific meanings of those words, so we'll do that in a minute. Now, for the last however many years since 2008, this law, Section 2801, has been sitting on the books. It wasn't until January 2025 that final regulations were published, and draft Form 708 is published and pending approval. Up until now, filing requirements have been deferred pending the issuance of guidance according to Notice 2009-85, Section 9. And the final regulations say that they apply to covered gifts or bequests received on or after January 1st, 2025. So I don't know what's going to happen to covered gifts or bequests received between when this law was enacted in 2008 and the beginning of 2025, but I did not see anything in the regulations that talked about applying this rule retroactively. So we'll see, but my guess is that the people who received covered gifts or bequests between 2008 and 2025, I think they're probably going to get lucky and they're not going to have to pay this tax retroactively. But we'll see. So let's start talking about what the Section 2801 tax is. It is a tax on covered gifts and bequests, and the tax is paid by the U.S. recipient of those covered gifts and bequests. So we need to define these terms. First, the tax. The tax is the highest rate of tax in Section 2001C. Currently, this is 40%, so you don't have a graduated rate of tax. What you have instead is a flat 40%, so it's a little worse than the typical estate tax. That 40% is multiplied by the value, the fair market value of the covered gift or bequest. And a covered gift or bequest is defined in Section 2801E1. This is any property acquired by gift directly or indirectly from an individual who, at the time of such acquisition, is a covered expatriate, and any property acquired directly or indirectly by reason of the death of an individual who immediately before such death was a covered expatriate. And covered expatriate here has the usual meaning under Section 877 Cap A G1. So looking at these, it's property acquired by gift or by reason of death, directly or indirectly from a covered expatriate. And the person who receives the gift or the inheritance, the tax doesn't happen unless that person is a U.S. recipient. And a U.S. recipient is defined under regulations, the new regulations that were published in January. This is an individual who's a citizen or resident of the United States for purposes of Chapter 11 or 12 of Subtitle B, as the case may be at the time of receipt of the covered gift or bequest. Furthermore, references to a U.S. citizen also include a domestic trust as well as an electing foreign trust. So, Chapter 11 of Subtitle B is estate tax. Chapter 12 of Subtitle B is gift tax. So, what this is telling us is that a U.S. citizen or resident uses the estate or the gift tax definition. So, in other words, we're back to the concept of domicile, and this is for the recipient of the covered gift or bequest. So we're looking at the concept of where do you live and what are your intentions for where to live for the recipient. There are some exceptions and modifications, of course. First of all, the tax on covered gifts and bequests applies only to amounts over the annual exclusion. The 2025 amount is $19,000. There is an exception for amounts that are already subject to U.S. gift or estate tax. We covered those topics just a minute ago. So if you're already paying U.S. gift or estate tax on a transfer as the transferor, then the transferee, even if it's a covered gift or bequest, does not have to also pay tax a second time. There's an exception for transfers to charity, an exception for transfers to your spouse if the marital deduction would have applied, an exception for qualified disclaimers, because if you choose not to receive your inheritance, then you're not taxed on it. And there's a reduction in the amount of tax for any foreign gift or estate tax paid. Now, if you are someone who might be subject to Section 2801 tax, or your heirs might be subject to Section 2801 tax, there's some things you can think about doing to prevent that. First is you can use the unified credit before expatriation. So before you become a covered expatriate, you can use your unified credit to give away up to $13.99 million to whoever you like, your U.S. heirs, the people who will eventually be your U.S. heirs, basically as a form of early estate planning so that they don't end up paying inheritance tax. If you're no longer domiciled in the U.S., you can give away intangibles or assets outside the U.S. Of course, if you're a covered expatriate, you would have to make sure not to give those to U.S. recipients because then they'll be paying the Section 2801 tax. Another thing I've seen people do is have their kids give up their U.S. citizenship too. Obviously, the adult children have to make that decision for themselves, but sometimes they don't have a lot of ties to the U.S., and they're happy to do it so they don't lose 40% of their inheritance. Another way to do this is to give to other non-U.S. recipients. Basically, don't give to U.S. recipients, and then they don't have to pay the tax on covered gifts and bequests. But think about this carefully, because you don't want to give indirect transfers where you give to a non-U.S. person who then gives to a U.S. person, because indirect transfers are also subject to the tax on covered gifts and bequests. Another option is to temporarily become a U.S. person again, and then you pay U.S. gift or estate tax. That's not the best solution because you're still paying the tax, but at least you get the better, somewhat slightly graduated rates rather than the flat 40%. And then lastly, there may be some areas where treaties modify the results even to the Section 2801 tax, and that could potentially be useful. So moving on to U.S. retirement income. Very, very common for people who expatriate from the United States to then have U.S. retirement income after expatriation. They might have eligible deferred compensation. That would be things like 401ks, and pensions, other deferred compensation that you filed Form W-8CE for. Ineligible deferred compensation, this would be the same type of stuff, but you didn't file Form W-8CE, and there's some stuff that has to be ineligible because it's foreign. So like foreign pensions are typically just about always ineligible deferred compensation. And then you might have specified tax deferred accounts. Those are things like IRAs, and there's some other stuff that qualifies as well, but IRAs are by far the most common. So just to take a quick look at the differences in how these are taxed at the time of exit and beyond. Eligible deferred compensation, it's that middle column, or the first column there. There's no exit tax, so there's no step up in basis, and then you get withholding of 30% on distributions. And the tax on distributions is a little bit of an oversimplification, but basically for the most part these are reported on Form 1040 NR page 1, and it's taxed at graduated rates. For ineligible deferred compensation or specified tax deferred accounts, it's different. These do have an exit tax event. It's taxed as a deemed lump sum distribution on the day before expatriation. Because you paid tax on it, there's a step up in your basis for U.S. tax purposes. And there is still a 30% withholding on the taxable portion of distributions. And again, this is a little bit of an oversimplification, but these distributions are taxed at graduated rates on page 1 of Form 1040 NR. If you look in the Form 1040 NR instructions, you'll see that distributions attributable to services performed in the U.S. are typically taxed as effectively connected income on page 1. Distributions attributable to services performed outside the U.S. when you were not a U.S. citizen or resident are not subject to U.S. tax. So important to take a look at that if you accumulated some of your retirement accounts inside the U.S. and some outside the U.S. In terms of withholding, for non-covered expatriates, you give Form W8BEN to your account custodian. If you live in a treaty country, you can claim the treaty benefits directly on that form, and typically the tax treaty will say that there's no withholding and no tax in the U.S. Actually, the treaty will say that it's not taxed in the U.S. If you claim that treaty benefit, then you can get 0% withholding. If you live in a non-treaty country, then you're going to be withheld at 30%. For covered expatriates, you provide Form W8CE for covered expatriate to the account custodian, and regardless of your country of residence, doesn't matter if a treaty applies to you, there's going to be 30% withholding. When you provide the W8CE, you waive the right to a treaty reduction in withholding. And this is a snippet from the W8CE, and you can see if you look, I'm not sure if you can see it, but if you look at line number 1 for eligible deferred compensation, it says, checking this box notifies the payer that you are irrevocably waiving any right to claim any reduction in withholding for such eligible deferred compensation item under any treaty with the United States. So you have to have withholding, no way to waive it if you have eligible deferred compensation. And just to further illustrate this with a little graph, the only way you don't have withholding on U.S. retirement accounts is you're non-covered and you live in a treaty country that has a 0% tax rate. Everyone else is going to have withholding. And so it's important to note that there's an ongoing U.S. income tax return filing requirement for most people who keep their U.S. retirement accounts after expatriation. And it's also an estate tax risk, so that's important to note as well. Non-covered expatriates in treaty countries with 0% tax, zero withholding are the exception, and for everyone else there's withholding at 30%. You report the income on Form 1040-NR, or a treaty may apply and you can claim the treaty benefit on your 1040-NR, but because you have withholding at 30% and graduated tax rates, almost certainly you'll either claim a refund or owe tax. So you'll need to file a U.S. tax return even though there's withholding. Solutions for moving retirement funds out of the U.S. As I mentioned, this is an estate tax risk, and it's also, you have to keep paying income tax in the U.S., and maybe more problematic, you have to keep filing U.S. tax returns and doing the paperwork every year. You can deliberately fail to file Form W8CE so that it's ineligible deferred compensation. So let's say you have a 401k and you don't file the W8CE. You pay exit tax on it as if the entire account is distributed the day before expatriation. Now you have a step up in basis for U.S. tax purposes, but when you had to pay the exit tax, there was no early withdrawal penalty because that's an exception that's in the expatriation rules. So you have this step up in basis, and then you empty or close the account in the following week after expatriation within the same tax year. It hasn't gone up much in value because it's only been a week. So on that actual distribution, most of it, the vast majority of it, probably will not be subject to tax because you just had the exit tax the week before. And the 10% early withdrawal penalty applies only to the taxable portion of the distribution, which is 0 or near 0. So yes, you've been taxed on your entire retirement account, but this allows you to avoid the early withdrawal penalty, move the funds outside the U.S. if you happen to be too young to take the withdrawal without incurring the penalty. Next, moving on to double tax problems. The general idea is there's going to be some assets that are subject to double tax for covered expatriates because first you pay exit tax in the US on a pretend event because you have a pretend sale of your worldwide assets when you expatriate. That gives you a step up in basis, which is normally a good thing. You pay tax, your basis goes up. Later, you have an actual income recognition event in the foreign country. You're no longer a U.S. taxpayer, so your U.S. step-up in basis doesn't help you in the foreign country. The exit tax you paid in the U.S. probably can't be used as a credit, and so you have a double tax problem. I want to look at 3 examples of double tax problems: foreign real estate, foreign pensions, and U.S. equities. So foreign real estate, this is exactly what I just talked about. You expatriate and you pay the exit tax, so you have gain recognition and a step up in basis for U.S. tax purposes. But now you're a non-resident alien of the U.S. You sell the house. Basis was not stepped up in the foreign country when you paid U.S. exit tax because there was no tax event in the foreign country, so there's no step up in basis there. And probably there's no tax credit in the foreign country for the exit tax you paid in the U.S. for a pretend event. So you're paying tax on the sale in the foreign country. You already paid tax on a pretend sale in the U.S. So this could be, if you have built-in gains, this could be a real problem. If you're running at a loss, it's not such a problem. Foreign pensions are another common issue that causes double tax for covered expatriates, often ineligible deferred compensation These cannot be eligible deferred compensation unless the payer makes an election to be treated as a U.S. person for 877A purposes, and that almost never happens in my experience. So it's taxed as if you took a lump sum distribution on the present value of the pension on the day before expatriation. As you exit the US, the pension is fully taxed, and now you live in another country. Pension distributions are typically taxed in the country of residence, and then you pay tax again on the pension as you take distributions. So this could result in a very high rate of tax on a foreign pension, and this is one of the main things that people try to plan around when they're planning for expatriation. U.S. equity is kind of the same thing as foreign real estate. You pay tax in the U.S. at the time of exit, but then you sell while living in a foreign country. Typically, gain from the sale of equities is taxed in the country of residence, so you might be paying tax in the foreign country. There are a lot of foreign countries that don't tax capital gains, so this one isn't always a problem. It's something to think about, though, and make sure that it's not going to be a problem for you. There are some solutions for double tax problems. One is you can live in a country that does not have income tax after expatriation, or a low tax country, so the second income tax never happens, or it's very low. And I've worked with a lot of people planning to expatriate who know they're going to have certain types of income and choose to live in a country that does not tax those certain types of income, or doesn't tax it for a period of years, so that they can get that specific benefit. And that's basically my second bullet point. It's you can plan carefully based on the specific laws of the country you live in. If you know you're going to have a lot of capital gain income, but where you're living doesn't tax capital gains, then you're okay. The other thing you can do is close out items that'll be subject to double tax before you expatriate, so you only pay the tax once. And that's not always possible. Sometimes foreign pensions, you can't just take a lump sum distribution, so that item in particular can be a little tricky to work around. Lastly, I want to talk about ongoing U.S. reporting. This is certainly a concern for some expatriates. If you have U.S. source income, it gets reported on Form 1040 NR. Estate and gift tax, we have Form 708. That requirement is going to be starting, I think, pretty soon for covered gifts and bequests. Yeah, you have Form 709, soon to be 709 NA for gifts made by a non-resident, not citizen. You have Form 706, and 706 NA already exists for a U.S. estate of a non-U.S. person. There's probably going to be withholding that you have to deal with. To show your status, you'll have to provide W-8BEN, W-8CE, depending on how you own things, possibly other W-8 series forms. Withholding will be reported to you, the taxpayer, on Form 1042S, Form 8805, that's for partnerships, Form 8288B, that's for the sale of U.S. real estate. And there is ongoing Form 8854 requirements for covered expatriates if they elected deferral of exit tax under Section 877 Cap A B. If they take distributions of eligible deferred compensation, they have to report that on 8854. And if they take distributions from non-grantor trusts, they have to report that on Form 8854. So the 8854 often does not only get filed for the year of expatriation, it often gets filed in future years as well. Under the exit tax deferral rules, tax is due when you dispose of the asset or when you die, whichever is earlier. And there's a requirement under Section 6039G to file an annual information return to certify that you still hold the asset, the security for it remains adequate, and treaty benefits remain waived. It's a quick snapshot of where and how that gets reported on the 8854. The other reason you'll need to continue filing Form 8854 each year is if you have eligible deferred comp or non-grantor trust distributions. You report all distributions and any amounts withheld on the 8854, and this would all be reported by the IRS to the U.S. payer and will tie to the amounts you report on your income tax return. So here's a snippet of the 8854 for those requirements. Part 3, line 2 is eligible deferred compensation. Part 2, line 3 is distributions from a non-grantor trust. So to wrap up, just a quick summary. When you're planning for expatriation, you want to trace what will happen over the lifetime of the asset, or over your lifetime with that asset. You have your exit tax, your basis adjustments, withholding when there's future income events, post-expatriation tax on the income, possible ongoing reporting in the U.S., then what happens to it when you die? Is it U.S. estate tax? Is it Section 2801? Is it neither? That would be great. And if all steps along the way create acceptable tax results, then you're good to go. So this is basically just a note about planning. If you're concerned about post-expatriation tax issues, the time to do that is before expatriation, and just follow it logically through what happens at each event every time something happens with the asset. Either you exit the US, you have income from it, you sell it, you die, and check the results of each of those events. So that's it for today. This presentation is not legal or tax advice. You can't use it to avoid penalties. Please hire a qualified professional to help you if you need help. I'm not your tax advisor. Just because you're watching this presentation or seeing it on YouTube. Here is my contact information. Thanks to all of you for participating. I encourage you to email us if you had a question that wasn't answered during the session. You can see my email there on the last slide. The next session will be July 25th, 2025. The topic will be Form 5471, the Section 962 election, and that'll be Phil Hodgen doing that presentation. If you're not already on our mailing list, please sign up to get the announcement emails about upcoming International Tax Lunch topics and Q&A sessions. You can go to hodgen.com to do this. And if you are already on the mailing list, and you probably are because you're listening to this, please tell your friends. See you next time.